All right. Today is Wednesday, June 9th. This is a recap for the stock market activities today. Let's start by the meme mania. It looked like another big day for meme stocks in the morning. They were rallying double digits in certain cases. However, once the market started trading in the regular hours, that was followed by a major dump. It was a pump during the pre-market and then dump it right away as soon as the market opens. And that raises the question, by the way, are retail traders really behind these moves? Or is it professional funds, hedge funds, and the likes utilizing these social media platforms, enticing the retail crowd to do their betting for them? Because you got to ask yourself a question. How many retail traders are trading the pre-market and pumping stocks before the market even starts trading? Pumping and dumping. This is classic hedge fund-like behavior. They pump the market during the after hours, the pre-market, and then dump it right away as soon as the market opens. And evidence number 2 that hedgies and Wall Streeters are behind these moves. The so-called meme stocks. We have another entrant to this mania, and it's called Invesco Mortgage Fund, the ticker IVR. Are we here to say that retail traders, amateur traders from Reddit and the likes, are pumping Invesco Mortgage Fund with about zero short interest? Really? Or are there professional funds and entities behind these moves? Watch out about this whole camaraderie of apes together and memes together and Robin Hoodiots together, donkeys united. Because in this business, every man and woman are on their own. There are no teams, there are no tribes. You make your own investment decisions, you get in and you get out however you see fit to your goals. Anyhow, here are some of the meme names and how they traded today. Take a look at a name with the ticker Wish. Who cares what the company does? This name was up big in the pre-market by the tune of over 30%, and then it closed down by the end of the day. Pump and dump right away. Likewise, Clover, which doubled yesterday. During the pre-market, it looked like it was going to be another good day for Clover. But as soon as the market opened, we saw the dump right away, and all in all, Clover lost about 30% or so. Similarly, with AMC closing the day in the red, down about 10% or so, and down again during the after hours. But the difference here is that AMC was actually down in the pre-market trading, and that is yet another indicator that the so-called apes, and by the way, for all you know, this term, the apes, was perhaps invented by a hedge fund marketing team, and they planned it on the Redditors and the likes. But AMC was trading down in the morning, and that suggests that the apes are hopping from one tree to the other, leaving the AMC tree and jumping to the Clover tree or the Workhorse tree, doesn't matter. The grass is greener on the other side. Some people made a killing trading AMC. They're booking the profits and they're jumping on the next ride. We also have GME, GameStop, also trading higher in the pre-market, but keeping those gains throughout the trading hours. And the reason is GME GameStop was to report earnings after hours. However, in the after hours session, GameStop is also joining the losses with other meme stocks. And one of the few meme names that managed to close in the green, trading higher in the pre-market and keeping those gains all the way till the end, the ticker CLNE, that was up big in the pre-market but also gained throughout the session. Likewise, my pick, Workhorse, also keeping the gains. But the question remains, these stocks in general will trade all together. And as we see significant losses in the after-hours session for GME, GameStop, perhaps we will see another ugly day for the meme stocks tomorrow. And the reason is we have an investigation from the SEC against GameStop and other companies. And that was revealed during the earnings call for GameStop. And by the way, they did about 12 minutes of earnings call. They did not take any questions, no transparency whatsoever. Hey, we used your money to hire some Amazon executives. Might as well take the money, blow it in Vegas, because this business is dead and there is no way to revive this business at all, with the exception of restructuring the business to become a streaming play, which is a long shot too. It's not easy to do. So all of these apes and Robin Hoodiots and the likes buying these meme stocks and holding to the moon. GameStop will be the next Amazon. What a colossal of stupidity. Speaking of stupidity, let's talk about the SEC, because they're talking big, but they're not taking any action. We know that this phenomenon about the meme stocks and all the market manipulation from both sides, the retail traders and the professionals, has been going on for a while. And the reason is the market is an unregulated jungle, and the SEC is not doing anything about it at all. If anything, the SEC is in a coma, and it has been for a long time. And now we have the new sheriff in town, Gary Gensler, and he's not doing anything either. He's just saying, I am calling for reforms and regulations. I'm asking for regulations. I'm hoping for regulations. Well, damn it, you're the boss, dummy. You can regulate on your own. You don't need permission from any other entity to start regulating. So stop asking about regulating and start regulating. I mean, this guy, I don't know what his problem is, but he just keeps laughing and smiling. Even when he's asked about serious issues, he's just smiling and laughing like a moron. You go to him and ask him, hey, Chairman Gensler, my grandma died yesterday. And he'll go, what a bunch of fools these regulators are. They get paid, no problem, but the question is, are they really working or not? Because the SEC has been a dormant organization for years. Likewise, how many Fed presidents do we pay? Hundreds of thousands of dollars, if not millions. They get free tickets and mortgages, free health care. Why do we need all of these Fed presidents and vice presidents and personalities whose job is to tour the country and do propaganda? And lastly, before we move on, let's talk about this meme stock mania and who's really benefiting from all of these moves. The geniuses over at Wall Street Bets and Reddit, they're talking about Clover, a garbage company, perhaps a scam, but they're stampeding buying those shares and call options, Naruto style, heads first, ask questions later, because they want to stick it to the man, right? Let's show these hedgies, these shorties, we'll show them. Well, guess what? The shorties, the hedgies, and the likes are the one benefiting from all of this, and you will be left holding the bag. For example, Citadel, you know, your boy King Griffin, who's laughing at you, you're making him richer by sticking it to the man. You're making the man richer. What a genius. They own a huge amount of shares of Clover, and they even own millions of dollars worth of options of Clover, calls and puts. Millions and millions of dollars. They bet on both sides. They make money both ways. While you're bragging about your quote-unquote gains and sticking it to the man is about to have a heart attack from laughing. You're making them more money than they have ever dreamed of or dreamt of. Who cares? And I bet that Mr. Griffin of Citadel has already closed all of these calls for a massive, massive amount of gains, perhaps making over $60 million from these calls alone. And now they're buying more puts and they're making money on the downside. But remember, you are a holy warrior. You know, you're fighting for a good cause while you hoodle the bag. You're sticking it to the man. What a bunch of baboons. Anyhow, let's start by covering the regular market. And here we go. The Dow Industrial Average closing in the red, down 152.88 points, or a decline of 0.44%. The Nasdaq down by 13.15 points, or a decline of 0.09%. The S&P 500 down by 7.71 points, or a decline of 0.18%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, healthcare. The number 2 for the silver, utilities. The number 3 for the bronze, real estate. Real estate has been an outperformer throughout the week. We will see how the real estate sector closes the week. On the other hand, the laggards of the day led by the classic inflationary stocks, industrials, materials, and financials. Not a good day for the inflationary crowd, meaning you and I, because the bond market is believing the Fed's argument as of for now. They're buying bonds before the release of the CPI, anticipating that the CPI reading will be cooler than expectations. We will talk about the CPI a lot more during the conclusion of this video. What about the market breadth, the advance to decline ratio? The NYSE 37% advancing versus 60% declining. The Nasdaq 43% advancing versus 53% declining. Moving on to futures, we saw modest losses for crude oil, both the WTI and Brent. Likewise, in softs, the decline of lumber futures goes on. We have another down day for lumber, but perhaps stabilizing at these levels. And lumber must keep these levels before the floodgates open. Likewise, we saw losses for coca futures. Meanwhile, gains led by cotton, coffee, and OJ futures. Meanwhile, sugar futures remain muted throughout the day. What about metals? Gold not making any move whatsoever. Gold is the mature guy in the room. The bond market decided to make their voice loud and clear. The bond market is betting that the CPI number will come cooler than expectations, and they are buying the Federal Reserve transitory argument. But the gold market is not buying it yet. The gold market wants to wait and see what happens after the outcome of the CPI release. Silver, on the other hand, rallying today by about over half a percentage point or so. Meanwhile, we're seeing declines here, once again for copper, but also for platinum and palladium futures. What about meats? Slight pullback for lean hogs and feeder cattle futures. Meanwhile, live cattle futures rallying higher. What about grains? A rebound for corn, but a bad picture across the board. We have significant losses here. For example, oats futures down by about 2.5%, but remember, gold oats pulling back after a massive rebound higher. So it is time for a pullback. Yet oats futures did not recover the prior highs, and that is important to watch. Have these commodities already topped for now? That remains the question. But we have more information that perhaps suggests otherwise, that we will see more gains, specifically for grains. And the reason is the drought picture is not looking so good. We have a historic severe drought throughout the country, but specifically in the western United States. They're calling it a mega drought, and experts are describing the conditions in the western United States as never seen before. We are reaching emergency situation here with the lack of water, which will reduce the output for this year and perhaps beyond. And once again, that means supply will come out short, and if demand continues to rise higher, specifically from China, grains prices will skyrocket, and we haven't seen the top yet. Likewise, for all of these inflation deniers, we're seeing inflation in meats, and it is becoming extremely evident. Go to the grocery store and watch out for meat prices. They have increased significantly, and now it's becoming hard not to notice. In the beginning, we saw the shrinkflation phenomena, meaning reducing the portion of the product, but keeping the price the same and hoping that the consumer is not going to notice. And even if they notice, they will not mind. But when it comes to meats, we buy by portion. You ask for 1 pound, 2 pounds. We buy meats by specific sizes. Therefore, shrinkflation is not going to work with meats, and consumers are noticing the increase in meat prices across the board. We have the biggest meat producer boosting wages, wage inflation, and they're also spending more to increase the capacity because the demand is not going anywhere. We're not going to turn vegan all of a sudden. I mean, being vegan is deflationary, but once again, you're going to demand more grains. So your demand shifts from meats to grains, and the result remains the same. Inflation is rising higher. People are not going to cease to eat unless they implant chips in our brains and we eat digitally. We start eating food as an NFT. Maybe that'll solve it. Moving on to the big casino, the options market. What's going on here? Watch out for the volume. This is how a gamma squeeze dies. And it is a gamma squeeze, not a short squeeze, with very few exceptions. AMC is the biggest evidence here that this is not a short squeeze. Matter of fact, there are more shorts hopping on the ride. The short float went down from about 20% to 18.5%, and now it's up again to 19.5%, meaning there are more shorts shorting this one. They're not believing that the price action will be sustainable, meaning AMC will be another pump and dump. A gamma squeeze starts, and it's a lot of fun to participate in during the early stages because the call options are extremely cheap. You buy them way out of the money. The stock blasts higher the very next day, and those call options appreciate sometimes by the tune of over 100 and even over 1,000% in a single day. But as the demand starts to increase on these call options and the implied volatility surges higher, they become extremely expensive. The premiums become extremely expensive, and even if the stock blasts higher the very next day, you're not going to make as much trading these very expensive call options. And therefore, the gamma squeeze becomes boring, it becomes mature, it is too expensive to ride this one, and you start to see these apes and traders abandoning the ship. In the case of AMC, we went from a peak of about 4 million contracts traded in a single day to this number today of about 950,000 contracts, a big drop, and about 65% of those were calls today. At number 2, Clover, CLOV, with about 900,000 contracts, about 65% of those were calls. At number 3, and this is very interesting, the inflationary stocks are down. It is not an inflationary theme today, but they pumped this stock anyways. It's an inflationary stock, a steel name, Cleveland Cliffs, the ticker CLF. We saw significant call options buying for this name, and they managed to bend the rules and make this name the exception. closing in the green by about 14.5% gains. Meanwhile, other steel names closed in the red. This is the power of the stampede. CLF closing at number 3 with about 750,000 contracts. About 86% of those were calls. And once again, you see the sticker IVR. Tell me again that these are retail traders trading Invesco Mortgage Capital. Give me a break. But you see the name I'm cheering for, and I issued this tweet a while ago. I said, forget about AMC, this is not a short squeeze. If you want a short squeeze, go with Workhorse, the ticker WKHS. And since then, the stock have doubled. Who knows how much juice left for the rally in this name and at what threshold it will trigger a short squeeze. My assumption is that they will trade together for the most part, meaning the meme stocks, all together. But we're seeing some divergences today. AMC down, Clover down, but you see Workhorse and CLNE, Clean Energy Fuels, closing in the green. Jumping from an old gamma squeeze to a newer one. Very typical behavior from retail investors. There are no apes together, every man and woman on their own. What about the unusual activities in the options market today? You see the IVR trade, we're not going to talk about that, but let's talk about the IWM. And this is a smart way, by the way, to bid against the meme stocks for cheap and without assuming a lot of risk by buying puts on the IWM. You could buy puts on AMC, and guess what? It doesn't go down, or worse, it goes higher, while other meme stocks go down. So if you want a meme ETF at the moment, there are a lot of them, the Buzz ETF and the likes, but the biggest one is the IWM. The weighting of all of these meme stocks in the Russell 2000 is reaching very dangerous levels. And this is a cheap way to bet against the meme mania. In this case, they're buying the 214 puts, expiration date July 2nd. With expectations that the name will drop over 7.5% by then, and they paid about $1 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker RIDE, Lordstown? The company comes out yesterday and says, folks, joke's on you, we might not even have cash to start the company. Matter of fact, we don't have the cash to start the company and produce cars. So they might end up using the money to sell hot dogs. And guess what? The retail traders, the SPAC generation, the NFT generation, this is exactly what they're looking for. When a company says we're about to go bankrupt, and by the way, we're a scam, we're not a real company, these Redditors, hodlers, the Robin Hoodiots and the likes go, this is exactly what we're looking for. Take my money. And they keep telling us that this is the smartest generation of investors. Give me a break. Lordstown drops significantly after revealing that they don't have enough cash to start the business. Retail traders immediately buy the dip and start betting to the upside because of this promised land dream. Oh bro, you don't understand. Just wait for the short squeeze to start and the stock will go to 10,000. Once again, what a bunch of fools. They don't even understand what shorting is and how the mechanics of the market work. They figured out this cute trick of triggering the gamma squeeze and some short squeezes, but that's about it. And now they're zombies high on meth chasing the next score with no rationale applied whatsoever. And in this case, they're betting for more upside for RIDE, Lordstown, by buying the 12 calls expiration date this upcoming Friday. You know, we invest for the long term, bro. And they're expecting the name to ride over 7% by then. They paid about 50 cents a piece to enter this trade. All in all, bringing the total to about $500,000. What about the trade for the ticker LI, Li Motors, or Li Auto, Chinese EV manufacturer? They're betting for more declines for the name by buying the 25 puts, expiration date June 25th, with expectations that the name will drop over 9% by then, and they paid about 70 cents a piece to enter this trade, all in all bringing the total to about $320,000. What about the trade for the ticker TRIP, TRIP? This is for TripAdvisor. They're making a significant bet here by buying the 45 calls, expiration date August 20th, with expectations that the name will rise over 5% by then. They paid about $3.65 to enter this trade, and with that, bringing the total to about $3 million. What about the trade for the ticker FSLY, Fastly? They're making a bearish bet this time around by buying the 50 puts, expiration date July 16th, with expectations that the name will decline over 8.5% by then. They paid about $3 a piece to enter this trade. All in all, bringing the total to about $2.4 million. More with interesting trades. What about the ticker ZM Zoom? They're making a bearish bet by buying the 315 puts, expiration date June 18th, with expectations that the name will drop over 5.5% by next week, and they paid about $2.50 a piece to enter this trade. All in all, bringing the total to about $1.6 million. What about the trade for the ticker BARK? This is BarkBox, and the name went to the public market via merger last week. They're betting for a sizable upside here for this business by buying the $15 calls, expiration date July 16th, with expectations that the name will rise over 25% by then. They paid about $1.40 a piece to enter this trade. All in all, bringing the total to about $1 million. What about the trade for the ticker MSFT, Microsoft? And this is an interesting one. They're buying the 267.5 calls, expiration date July 23rd, with expectations that the name will rise over 5.5% by then. They paid about $2.50 a piece to enter this trade. All in all, bringing the total to about $1.5 million. Lastly, what about the trade for the ticker ACMR? This is for ACM. It's a semiconductor name, and this one is a highly unusual trade because the options volume for this name has been stable for a very long time. It's not a usual name in these lists, but all of a sudden today we're seeing unusual activities and a lot of call options buying for this name. In this case, they're buying the 100 calls, expiration date July 16th, with expectations that the name will rise over 23.5% by then, and they paid about $2.50 a piece to enter this trade. All in all, bringing the total to about $1.25 million. Moving on to the heat map analysis. Right away, combining the heat map with the action from the bonds market. What is the theme? The theme is an assumption that tomorrow's CPI number will become cooler than expectations, and therefore we will see a lot of pain in bond yields, in the financial sector of the market, but other inflationary sectors, the likes of industrials, energy, and materials. But there is a flip side to that coin. If financials, industrials, energy, and materials will fall out of favor because the CPI number will indicate transitory inflation, then shouldn't that also favor the NASDAQ and the high multiple names? Well, we're not seeing that in the reaction of the market today. Matter of fact, big cap technology names are muted, the software names are down, the majority of the tech and high multiple names are down, not trading higher. We're actually seeing the action in the healthcare sector, the neutral sector of the market, catching a bid today. So I'm not so sure that the market's assumption of the CPI number coming out too cool is correct or not. It could be de-risking behavior. From the bonds market, they shorted a lot of bonds, and the last few days they covered their shorts, and they're anticipating and waiting the release of the new CPI number. Likewise, we're seeing a lot of profit taking in the banking sector, industrials, and other inflationary stocks. Not because of a belief, a firm one, that inflation is transitory, but why not take and book the gains before the release of the big number? What if the big number comes out contrary to your interest? Why not taking some profits off the table? So once again, I'm not buying this move of the market. I think it's a result of fear and hesitation and de-risking, but we will see the true market reaction right after the release of the CPI. And once again, if the number is cooler than expected, you know what's going to happen. The tech sector will light up like a Christmas tree, all green. Meanwhile, you will see a lot of pain in the financial sector, but there are no guarantees of how the market will perceive the number. It could be, as a lot of people are expecting right now, that the number will come down the middle, confusing the market even more than it is confused right now. We have a lot to discuss during the conclusion of this video, but for now we're moving on to the themes analysis. And there is an error here with the reopening names. Certain names that closed in the red are not colored in red, but anyhow, it was a profit-taking, de-risking day for the reopening names, mostly closing in the red, but not by much. It's a fascinating debate between the transitory and the inflationary crowd, and it's not really between the reinflationary and the transitory crowd. It is between those who believe that perhaps the CPI reading peaked last month from a basis effects, meaning that we will see higher inflation in the reading, but it will not be as hot as last month's reading from a base effect perspective. Keep that thought in mind. What about the inflationary stocks? The picture is clear. Lots of losses here, not significant ones, with exception of UPS. UPS had an analyst call in the morning today, and they have indicated higher inflation, and therefore they're becoming selective on which type of packages they're accepting. They're not interested in shrinking their margins by accepting unfavorable packages to ship. And that's all there is. The company can't command higher prices. They can pass the extra cost to the end customer. You can do that with commercial shipping, for example. But what they're talking about here is the smaller packages from individual customers. The company's ability to pass the extra cost to this type of end customer is extremely limited. Yet their ability to jack prices for commercial consumers is a lot more flexible. And therefore, I think that this was an overreaction dumping UPS shares. Meanwhile, what I heard was positive. They're getting rid of certain packages and shipping obligations that are not very profitable. That's good because it trims unneeded fat out of the company. It becomes leaner and more profitable. What about the deflation stocks? Not rallying higher. And pay attention here. The bonds market reaction, which was extreme and aggressive in my opinion. Buying bonds like there is no tomorrow, anticipating a cold CPI reading. But the stock market and the currency exchange are not sending the same message. You're not seeing these names, the high multiple names, the momentum names, rallying significantly higher. And that once again supports the theory that the bond buying that we saw the last few days and today is due to short covering and the 10-year auction that took place today. It was met with very high demand, and perhaps these buyers are also panicking. What if the CPI comes out cooler than expected? What if the Fed is right about transitory? Why not stampede and buy bonds right now and see what happens? And that pushed yields significantly lower. But when it comes to the stock market, here it is. The mania names, the high multiple names not participating with the bonds market. Moving on to charts. And let's start with AMC. Here's a 30 minutes chart, and we talked about the symmetrical triangle consolidation pattern. The fact that once the chart breaks to the downside, we will start to see significant losses. And we're starting to see that from the price action today. There is a number here where AMC will hit, and that will open a sinkhole for the shares to start dropping rapidly and significantly, perhaps going all the way to close the gap at 32. If that fails, closing the next gap at 26. It could happen extremely rapidly. There is a number, I don't know what it is, but once you crack below that number, the sinkhole, the floodgates will open right away. For now, we have not reached that number yet, so the apes still have the benefit of the doubt. If they pour in and buy more call options, notice the volume for calls and the overall volume in the options market for AMC dropping from 4 million to 900,000. That is not going to support the price action higher. You need more apes to go ape shit crazy and buy call options. But here's the challenge, and here's what I told you before. Be careful, because the gamma squeeze will end when the apes are not able to buy these very expensive, high premium call options. The apes might be stupid, but they're smart enough to realize that this is a bad deal. The premiums for call options don't make sense at all. The risk versus reward doesn't cut it, and that's when the gamma squeeze starts to frizzle out. For now, there is hope for the apes to prevent the floodgate scenario. But there is a threshold, there is a number. It could be 45, 40. Cracking below that number, and you will see a sharp, rapid move to the downside. And by the way, switching to the line chart of AMC, you have a lot of genius apes contacting me, and with the nasty comments, of course, and saying, bro, you said the Twin Peaks. You're wrong. The stock is going higher. To the moon, bro. Meanwhile, here is the Twin Peaks. The same topping pattern from the last time around, the first episode of the Mania. Compare the two tops. They look eerily similar. And we have the Twin Peaks in the RSI indicator and the 30 minutes chart. And indeed, that was the top, at least for now. So what are you complaining about, ape? Moving on to the SPY 30 minutes chart, struggling over and over and over again to break above 423. And the chart is starting to pull away to the downside, pulling back from 423. This is not a good signal, but it is not a death sentence yet for the SPY until and unless 420 is broken. Moving on to a daily chart of the continuous contract for the S&P 500. Once again, the SPY is struggling to break above the 423 resistance level. And the equivalent of this level in the futures daily chart is 4,232. And boy, this is an epic battle, going back and forth for days now. If we look under the hood, the 30 minutes chart for the continuous contract, you can see the reaction. This is right now the 7th reaction, and the S&P 500 futures unable to crack above 4,232. Understand that this consolidation is a gathering of energy, and eventually the S&P 500 futures will be able to crack above the resistance level of 4,232 and release that massive energy to the upside. But if that energy is not released to the upside, it will be released to the downside. And there is a threshold we have to watch for. And this threshold is 4,214.5. A very specific number, but it is important to keep, because if the SPY futures crack below that level, we will start to pave the conclusion that the S&P 500 doesn't have what it takes to crack above 4,232. There is not enough fuel in the tank to do the move. And therefore, it has to go down the previous support level. And that is going to be way down. We're going to see a sharp pullback for the SPY. For now, the battle goes on. What about the NASDAQ 30 minutes chart? We saw the bear flag formation. The chart attempted to fight back the bear flag formation by gapping higher, but immediately was sold off all the way till the end of the day, closing at the bottom. This is not a good setup for tomorrow. You're expecting the NASDAQ to rally. If the market has this consensus that inflation is transitory and the bond market going bananas buying all of these bonds, why aren't they pumping the NASDAQ higher? What's going on with the lack of confidence? Again, I wouldn't bet against the NASDAQ right now, and I wouldn't bet for it. You can play the betting game all the way till Friday with options, because the number will be released tomorrow, and you're going to know right away whether you're right or wrong. And if you're right, you're going to score big, assuming that the number will swing sharply one way or the other. But if it comes down the middle, and that seems to be more likely than before, then perhaps we're not going to see sharp moves in the market one way or the other, and all of these options will decay in value. Moving on to the daily chart of the continuous contract of the NASDAQ, we're comfortably above 13,718. So we're not talking about that level anymore. The NASDAQ not looking bad at all. It is just waiting and waiting and waiting for the catalyst. If the CPI gives the green light for the NASDAQ to rally, it will create an explosive move to the upside, perhaps cracking the resistance of 14,000. What about the IWM small caps? 30 minutes chart. I showed you the range, the channel of consolidation. We talked about reaching the upper limit of the consolidation, and that will perhaps pave the way for a pullback all the way to the lower level of the consolidation. This is exactly what happened. You're seeing the ping pong game within a certain specified channel of consolidation. Breaking one edge one way or the other will indicate the next move for the IWM. Breaking the lower edge will mean that the chart perhaps will decline all the way to meet the prior level of support at around 223, and that will be a sharp drop for the IWM. And here is the daily chart for the Russell 2000. The daily chart still looking bullish. We're trading above 2,264, and the next resistance level is 2,360. For now, the IWM, the Russell 2000, the big picture, the bulls still have the advantage until we see a weekly closing below 2,264. What about the Dixie? Talk about conflicting messages. The bond market is saying one thing, the dollar index is saying nothing. The dollar index is not confirming the move in the bonds market. Had it traded down significantly today, we would have said we have a confirmation from the currency market. The US dollar is confirming the move in the bond market. We don't have this confirmation yet. Therefore, expect the unexpected. Expect the surprise to the upside, that inflation will be hotter than expected and yields will explode higher once again, along with the US dollar. That is a possibility. The US dollar not saying anything right now, playing poker and keeping us on the edge of our seats. And here is the chart of the day. Yields, specifically the 10-year Treasury yield, down significantly today. We saw huge demand from the auction, the price-to-bid ratio, and that took yields to the very important must-keep level of 1.5%. Must keep by the end of the week. If yields close below that number, then the transitory argument will win, at least in the interim, and you will see the NASDAQ blasting higher, TLT blasting higher. Hello again to the ARC mania, the meme stocks, the high multiple stocks, all of those are going to blast higher. That is the assumption. But every time we see the bond market reacting ahead of time with extremes, it is usually wrong. Last time around, last month, yields traded higher in anticipation of the non-farm payroll number. And that assumption was wrong because the non-farm payrolls came out lighter, much lighter than expectations. And you saw yields pulling back right away. This time around, yields are pulling back significantly ahead of the release of the number. So the surprise element will be to the upside, not to the downside. And remember this, inflation is rising all around us. There is no doubt. The facts are evident everywhere, even in foreign bond markets. Whether we're talking about German bonds, Italian and French bonds, the yields on those are rising higher, indicating more reinflationary action in the broader global economy. But magically, US bonds are getting bought and yields are dropping, contrary to the global consensus. What does that mean? It means that Papa Jerome and the Federal Reserve are manipulating the bond market behind the scenes. In addition of buying hundreds of billions of dollars worth of bonds every single month to keep yields tamed and capped, they're also conducting Operation Twist. They're not saying that publicly, but actions speak louder than words. You look at their balance sheet, you look at their asset purchasing, it is increasing rapidly without announcing any official Operation Twist. So market manipulation has an element to the move to the downside, but also the fear from bond market investors that the Fed could win the argument, at least in the short term, and they don't want to be exposed to the risk of holding a short position in these bonds all the way till the release of the number. What about gold? Here's another very important indicator, playing poker once again and not saying anything. Unlike bonds, the US dollar and gold are not saying anything at all. And gold is even more mysterious than the US dollar. We know how the US dollar will react. If the number is too hot and the tapering discussion becomes more imminent, then the US dollar will rise higher because the printing machine will slow down. But the reaction of gold, the assumption is we have an inverse correlation between gold and yields. So if the number comes out too hot and yields blast higher, the assumption is that gold will collapse. But what if magically gold decides to channel its old self, the hedge against inflation, and starts to rally hand in hand with yields? Therefore, I'm not comfortable making a call regarding gold. I know how the KRE, the regional banks ETF, will react to the CPI number one way or the other. I know how the dollar will react, but I have no clue how gold and silver will react. What about the VIX? The VIX popping higher today. This is reasonable. It is anticipated. We have an important number with huge implications for the overall stock market being released tomorrow. And therefore, buying protection in the VIX is anticipated and highly expected. However, switching to the weekly chart and looking at the MACD indicator on its own, what do we see here? The VIX is lacking momentum. It is bottoming in terms of momentum. There is a reversion to the mean. There's about to happen anytime soon. And that reversion to the mean is higher, not lower. What does that mean? It means that the momentum will strengthen from a weekly perspective for the VIX, the volatility index. If that happens, that will push VIX prices higher and the SPY, the S&P 500, downward. So watch out for this chart from a weekly perspective, not a daily perspective. What about Apple? What's going on here? 30 minutes chart, the biggest stock in the world. Nothing is going on here, consolidating within range. This is the same consolidation range between 127 and 128. We know that the support is 125. That has been tested and confirmed. So that is a solid bottom for Apple. We have a gap. The chart could go down all the way there, closing that gap and then reacting one way or the other. But for now, not doing anything, consolidating in a bullish form, awaiting the release of the CPI. What about Tesla, the souffle? What's going on here? We have a flat day for the souffle. Nothing is going on. The action has shifted from Tesla and RKK and the momentum stocks to the meme stocks. No love for Tesla options one way or the other, which creates the opportunity for us who are looking to trade Tesla in the next few months to start accumulating options positions now. The chart has struggled to break above 629. That remains the target for the weekly closing. Closing below that number will be a bearish signal for Tesla, paving the way to crack below the support level of 540. But we know what will spark the move one way or the other, and specifically to the upside. If the CPI number comes out too cool, that will incentivize market participants to bid the high multiple names. The poster boy for the high multiple names is Tesla. So my expectations are, if the CPI number comes out too cool, indicating transitory inflation, Tesla will spark higher. And the opposite is true. If the CPI number is too hot, we will see more pain for the Nasdaq and specifically the high multiple names led by ARK Invest and Tesla. What about the tulip market starting BTC, Bitcoin? What's going on here? We're trading on the heels of the bad news that the government has recovered, which actually good news, not bad news. It's bad news for Bitcoin, but it's good news for justice because the government recovered all of the ransom money paid via cryptocurrencies in the colonial pipeline hacking or ransomware. But I also cautioned yesterday from these death sentence calls from certain analysts saying that BTC, Bitcoin will drop and it's the end, it's going to crash, etc., etc. You cannot make certain calls like this when the chart is consolidating within range and no violations one way or the other took place. The range is the support level of 30,000 and the resistance level of 42,000. Unless one of these two is violated, the chart is expected to trade within range. The momentum indicators are turning positive for Bitcoin, but the ultimate test will be if this positive momentum continues, is reclaiming 42,000 for support. That will be extremely difficult, by the way. However, if we see a meme stock crash, you wake up tomorrow, GameStop down 50%, AMC down 20-30%, then you're going to see a lot of money rotating back to the crypto market, buying the dip in Bitcoin and the likes, specifically Dogecoin. Speaking of, here is the chart of Doge, 4 hours chart. We talked about the mid-ground of 35 cents, trading above that threshold, and the chart remains bullish, trading below that number, and the chart remains bearish. We have the support of 21 cents, we have the resistance of 45 cents. A wide range, but this is very, very volatile. The momentum indicators are turning positive. Could it be that Dogecoin is preparing the next move higher to take another crack at 45 cents, the prior resistance, and see what happens this time around? Here's another one, ETH, Ethereum, trading above 2,500, reclaiming that level for support. The momentum indicator is still weak, but on the positive side, still holding the 2,500 support level. Breaking that level, and then we have a problem with this chart. Moving on to the conclusion of this video. The big day tomorrow, the CPI number. We talked a lot about the number and the expectations, the bonds market reaction. So let's talk about my expectations of the number. How do I read the number? I'm looking at energy prices, specifically gasoline prices. And remember, the whole argument of transitory is based on the base effect. What is the base effect? For example, dismissing the huge number of the CPI last month due to base effects, because we're comparing the number and the growth year over year. Last month was the bottom of the valley right after the COVID-19 crash, and then prices started to recover. So you could hear the Fed and say, all right, I hear you, Federal Reserve. Perhaps it's not a fair comparison. And perhaps the transitory argument is still possible due to the base effects. But now as we start to compare the numbers year over year, as these numbers started to recover from the April bottom, it was actually the March bottom, and then started to accelerate and recover higher April, May, June, and beyond. So if the CPI number is still hot, even though the basis effect are recovering, that will indicate that inflation is not transitory. However, if the number shrinks significantly from the reading last month, then the transitory argument will gain more steam. So here is what I'm looking for. Gasoline prices. In May 21, the average price was around $3 a gallon, and the base effect will work as the following. Last year, May 2020, the average gasoline prices nationwide was $1.96 a gallon, and that's a sharp increase year over year, even bigger than last month. Because look at April 2021 was around $3 a gallon, and again the reading for April 2020 was about 1.93 cents a gallon. So my expectations are that gasoline prices will hold the same base effect impact from last month. So this is not the one we're looking for. This is not the one that will cool the CPI reading. If anything, gasoline prices will push the CPI higher slightly. What about the big one, used car prices? This was responsible for the majority of the gains last month in the CPI reading. So what do we have here? May 2021, used car prices are still climbing higher. Now, we don't know how the Memorial Day sales impacted the sticker price for used cars. If it was a big sale and the demand skyrocketed during the Memorial Day sales weekend, that could manipulate the number a little lower. But once again, is the CPI reading about to cool off based on gasoline prices? No. Will it cool off Based on used car prices, not really, because used car prices continue to climb. So yes, you might have the difference between the basis effects, because remember, used car prices started to recover from the bottom last year. So that number could shrink from the base effect perspective. But keep in mind that used car prices continue to climb higher. So those inflation deniers are not going to get relief from used car prices. What's next? Airfare prices. It is not your imagination. Rising airfares and hotel rates are making vacations more expensive. Remember, when we talk about the base effects, airplane ticket prices were in the dumps last year, hit the bottom in March 2020, but it did not recover. Airfare ticket prices did not recover in the following month, April, May, June. We did not see a massive recovery, a V-shaped recovery in airfare prices. Meanwhile, the prices this year are climbing significantly higher. So if anything, when it comes to airfare prices, the base effects will be in favor of a hotter CPI reading. Domestic US fares are up 9% since April 1st, while international fares are up 17%. What else? This is the sleeping giant, the big one, and perhaps the nail in the coffin for inflation deniers and the Federal Reserve. You know, the transitory crowd. This could be the nail in the coffin. Rental prices. As you can see, property rental prices collapsed last year, bottoming around March, April, May, and then climbing higher. But this year so far, rental prices skyrocketed significantly, not just to recover the pre-pandemic trajectory, but trade above the pre-pandemic trajectory. Point number one. Point number two. While rental prices are rising across the country, there are exceptions, and these exceptions are the big cities where people moved out of during the pandemic. We're talking about New York City. We're talking about Chicago. We're talking about Los Angeles. We're talking about San Francisco and Seattle. And that is keeping rental prices from rising higher overall, and therefore not contributing so much to the CPI reading last month. If anything, this was a deflationary factor, but this is also rapidly changing because rental prices in these cities, San Francisco, New York, Chicago, Boston, Seattle, are increasing rapidly. The recovery is very, very steep. Meaning that if anything, rental prices this time around will support a higher CPI reading, not a lower reading. And here's the other point. While New York, Los Angeles, San Francisco, the laggards in the housing rental market are starting to recover sharply this year, are we seeing a slowdown in other markets, the markets that were gaining during the pandemic? We're talking about Boise, Idaho. We're talking about Mesa, Arizona, Glendale, Phoenix, Henderson, Nevada, Reno, Nevada, all of these places that Californians migrated to, pushing rental prices and property prices higher in these particular cities. There is no slowdown, ladies and gentlemen. We're not seeing a recovery in property prices and rental prices in the big cities on the expense of smaller suburban cities that people migrated to during the pandemic. These cities are still growing and prices are still surging higher. So if anything, rental prices, the sleeping giant, will push the CPI reading higher. Lastly, we know the corrupt BLS, the Bureau of Labor Statistics, are going to be busy. The kitchen will be extremely busy in the morning, trying and attempting to cook the number to please the stock market, because that is the objective after all, to please the market and please the Biden administration and the Federal Reserve by saying, you see, all of this printing, all of this spending mania, the tsunami of liquidity, trillions and trillions and trillions of dollars are creating a transitory inflation. So print, baby, print. But is cook, baby, cook as easy as print, baby, print? That is the $1 million question. And by the way, even the Communist Chinese Party, the CCP, are struggling to hide the inflation number in their own official numbers. They cannot hide the truth that inflation is rising higher, and producer prices in China are rising higher. And perhaps the biggest deflationary factor in the last 20 years, China is actually changing and becoming an inflationary factor, exporting inflation across the globe. So shame on the BLS if they attempt to cook the number and hide the truth, because after all, isn't it a sad day when you can rely on the CCP numbers and trust these numbers more than the United States Bureau of Labor Statistics numbers? Anyhow, that's all I got for you tonight, and I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button,
the notification button, and follow me on social media.